our approach to evaluating growth stocks on the basis of the benchmark return remains a conservative one. Active reinvestment returns revisited. As we pointed out earlier, calculating returns to active reinvestment of retained earnings involves both practical and theoretical complexities that require separate, more detailed discussion. Estimate of the current cash return is straightforward. For the benchmark return, calculating the organic growth return, which in the benchmark case equals the organic growth rate in earnings, is also relatively uncomplicated. We describe the process in the consolidated general example. For the active reinvestment component of returns, the value created is the amount invested times the value creation factor associated with each dollar reinvested. The associated return contribution is the value created divided by the price paid for the company in question. The math is uncomplicated. The difficulty lies first in defining and identifying the amount that a company actively reinvests, and then in defining and identifying the value creation factor associated with that investment. We will deal with each of these issues separately. The complication in calculating the amount reinvested arises because some active investment does not get identified as such in standard financial accounts. Expenditures on research and development, new customer acquisition, and improved operational efficiency typically do not get treated as investments for accounting purposes. To the extent that this spending is to sustain the quality of a firm's product portfolio, customer base, and operating structure, leaving them at the end of the year just as capable as they were at the start of the year, no net investment is involved. The new investment merely offsets the depreciation of unaccounted for intangible assets as products become obsolete, customers leave, and operating discipline deteriorates. However, in cases where these hidden investments generate net business improvements, they are in effect net investments in intangible assets. If the spending were capitalized rather than expensed, operating margins and net income would be higher. In that framework, this spending represents active reinvestment. Fortunately, where the level of hidden net investment relative to the size of a business is stable, we need not account for its effect explicitly. The associated returns will show up as steady earnings growth above the growth attributable to organic market factors and explicitly identified active investments. The earnings growth at issue will often be included as part of organic growth in earnings. If we believe we can identify significant levels of hidden net investment in a business, we should be able to account for it as part of a historically elevated R&D or other operating expenses which accompany higher than average growth rates. Assuming net hidden investments continue at past levels, we can simply incorporate the higher historical growth rate in our estimate of future growth in value. If the historical growth does not exceed our conventionally calculated organic plus active reinvestment growth rate, then any hidden investment appears unlikely to be making a significant value contribution, in which case its impact can be safely ignored. The value creation factor. Estimate of a valuation creation factor is a complex task representing both practical and theoretical issues. It will be useful, therefore, to keep certain broadly applicable principles in mind. First, value creation factors. The ratio of the return to the cost of capital, greater than 1, apply only to investments protected by sustainable existing competitive advantages, or moats. New business initiatives, whether by acquisition or direct investment, that do not occur within a franchise will at most have value creation factors of 1. Historically, more often than not, they have been significantly less than 1, representing major value destruction. Financial investments in competitive markets will also have value creation factors of 1, or if they are subject to double taxation, less than 1. Only well-focused investments in operational efficiencies, and those that extend existing competitive advantages geographically or in product space, will have value creation factors above 1. Second, Precise value creation factor estimates will not be necessary for companies that distribute more than 3/4 of their earnings. Suppose a franchise trades at an earnings return, sustainable earnings divided by market price, of 6.5%, which is a sustainable multiple of 15, a potentially attractive rate for a growing franchise business. If it distributes 75% of its earnings, retained earnings will equal roughly 1.6% of the price of the firm, 6.5% times 25%. Some small amount will be required to support organic growth. At most, 1.5% of the market price will be actively reinvested. Average capital allocation, a value creation factor of 1, will add 1.5% to the overall benchmark return. Poor capital allocation, say with a value creation factor of 0.5, will add 0.75% to the benchmark return. Good capital allocation, a value creation factor of 1.5, would add 2.25%. Variations of 0.25 in the value creation factor around these levels will affect the active investment return by less than 0.4%, an amount that should not be critical to a sound investment decision. For companies that distribute 3/4 or more of their earnings, broad judgments of the quality of capital allocation should be adequate. Third, if a company retains 1/3 or more of earnings, and the growth in operating earnings can be accounted for largely by organic growth, i.e., the overall historical earnings growth rate is 1% or less above that implied by organic growth alone, then the value creation factor has historically been close to 0. Without clear evidence of improvement in capital allocation practices, a value creation factor of 0 or close should be used. Finally, retained earnings are often held in cash or used to retire debt that presents no major threat of impairing business operations. The returns to these actions depend on what is ultimately done with the cash or the debt capacity. In the best case, the available funds will be distributed to shareholders. In the worst case, they will be expended on value-destroying investments, for which a value creation factor of less than 1/2 is appropriate. But even in the best case, the tax consequences of holding cash, the interest is taxed, or paying down debt, reducing the tax shield of paying interest, means that the value creation factor is less than 1. In practice, these kinds of investments warrant a value creation factor of around 0.8, sparing the reader the detailed calculations underlying this figure. We have to know how management allocates active investment among initiatives that 1. Improve efficiency, 2. Extend either the geographic footprint with new stores or production facilities or product lines, or 3. Acquire new business or invest in other new revenue acquisition projects, such as expensive marketing campaigns. For each of these distinct types of investments, we need to estimate a range of returns relative to the associated cost of capital. In some cases, these returns can be gleaned from broad industry data. For example, efficiency-improving investments have historically had payback periods of between 6 months and 2 years, a pre-tax annual rate of return from 50 to 200%. A value creation factor of 5 or more is not excessive for these investments, which usually constitute only a small fraction of overall capital budgets. In some instances, industry experts have produced detailed return calculations that are publicly available. There is an extensive literature on the returns to Walmart from new superstore openings and the conversion of existing stores to the superstore format. The returns to acquisitions can often be estimated from post-acquisition financial reports. A weighted average of these individual category returns will then yield an overall value creation factor for the company under consideration. A theoretical problem with estimating value creation factors arises because the ultimate value of any active investment depends on what happens to the returns generated by that investment. The default assumption is that they are fully distributed to shareholders. In that case, each dollar of return is worth exactly $1, and we need not worry further about what happens to active reinvestment returns. But if all or part of the initial returns is actively reinvested in other projects, the value per dollar of the initial return depends on the value creation factors associated with these secondary investments. But the value of these secondary investments depends in turn on what is done with their returns, and so on, in a theoretically infinite sequence. We cannot calculate a value creation factor unless we can calculate the returns of the proceeds of an active investment that depend on an as yet unknown value creation factor for those proceeds. One exit from this difficulty is to simply make the default assumption that net active investment proceeds are fully distributed to investors. But it would still be useful to know how this assumption is likely to affect our calculated value creation factors when a substantial part of the active reinvestment returns are themselves reinvested. We address this problem in the appendix to this chapter. Here, we will simply state the results of that investigation for two polar cases. In the first case, secondary reinvestments neither create nor destroy value. The assumption is that all of the value-creating investment opportunities are fully funded from the primary retained earnings, essentially that the level of retained earnings is set to meet this objective. This situation is equivalent to the default assumption that active investments returns are fully distributed to investors, since in both cases the value creation factor is 1. With a value creation factor of 1, it makes no difference whether earnings are distributed or fully reinvested. Thus, the incremental return per dollar of active reinvestment, the value creation factor, is equal to incremental earnings plus the organic growth rate in the incremental earnings. In the second polar case, the value creation factors on the original active reinvestment and on the reinvestment of the proceeds of the original investment are equal. This assumes that the original active reinvestment level does not exhaust or even diminish value-creating opportunities. In other words, the returns from the first round of capital allocation are compounded by the second round and subsequent rounds with an equivalent value creation factor. If the initial capital allocation creates value, a value creation factor greater than 1, under the assumption of case 1 before, then the actual value creation factor is even greater than the case 1 value creation factor. Thus, use of the value creation factor of case 1 is conservative. By contrast, if the initial capital allocation under the assumptions of case 1 destroys value, then in a case 2 reality, things are even worse. Management with consistently bad capital allocation of both initial and secondary returns should generally be avoided unless current cash returns are likely to be sustainable and by themselves exceed a business cost of capital. Recap. We begin this chapter by identifying the need for an approach to investing in franchise/growth businesses that did not rely on estimates of current intrinsic value. The values of such businesses are extremely sensitive to variations in growth rates and costs of capital. As a result, they cannot be estimated with the degree of precision required to provide a sound basis for investment decisions. An alternative approach is to calculate an expected future return from buying the business at its current market price and to compare that return to an appropriate cost of capital. The process developed in this chapter for implementing this approach should mitigate the problem of extreme sensitivity to growth rates and costs of capital, leading to better franchise/growth investing, especially for value investors who have shied away from investing in growth stocks. The return approach has several other advantages. First and most important is the direct, linear relationship among the critical factors that determine the margin of safety in returns. The estimated return is the simple sum of a growth rate and a current cash return. A 1% increase in the forecast growth in earnings raises the expected return by 1%. This relationship holds for all current levels of earnings, all costs of capital, and all fade rates. A 1% increase in organic growth increases the overall growth rate by 1%, regardless of the level of active investment. A 1% change in the cost of capital changes the margin of safety by 1%. Analysis of the sensitivity of investment decisions to changes in these underlying factors is simple and straightforward. This simplicity is in marked contrast to the complicated, interdependent relationships between these factors and any measure of intrinsic value. For intrinsic value, the impact of a 1% change in growth rates depends on the level of the cost of capital, the level of cash returns, and, if it is even recognized, the franchise fade rate. Changes in earnings power estimates do have more complicated implications, but even in this case, the sensitivity analysis is far more direct than for intrinsic value. A 1% change in earnings power leads, other things being equal, to a 1% change in cash distributions. If the cash distribution return is 3%, the 1% change adds 3 basis points to the expected return. Added complexity arises because retained earnings and active reinvestment also increase. But if we have a well-formed idea of the value creation associated with active reinvestment, then we merely multiply the increase in retained earnings by the value creation factor and divide by the market price of the company to arrive at the change in return. A second benefit of the return approach is that it isolates the individual factors that determine the attractiveness of a franchise company investment so that research efforts can be focused efficiently on those that are most important. Current earnings power, distribution and reinvestment policy, organic growth, active investment effectiveness, franchise fade, and the appropriate cost of capital can each be investigated independently. Many of these factors are often overlooked in a conventional intrinsic value analysis. The distinction between organic growth and the results of the capital allocation decisions that constitute active reinvestment often goes unrecognized. The effect of distribution policy on organic growth is minimal, but the effect on the amount available for reinvestment is significant. The difference between current franchise strength, which affects margins and earnings power, and franchise stability, which may be imperiled by the fade rate, is also often ignored. Using a return framework, these differences are clearly recognized, and the impacts of the individual factors are relatively easy to trace. The return approach highlights the particular importance of franchise fade, which is rarely analyzed effectively, if at all, by conventional intrinsic value methods. Finally, a return approach by its nature focuses on the very long-run future. When we use a constant growth assumption, the growth rates should be an average for the whole of the future that plays a significant role in determining today's value. That may be 40 years or more. Fade rate assumptions do the same thing. A 40-year half-life corresponds to an annual fade rate of 1.8%. A very long-run focus is essential for investing in franchise businesses and taking advantage of the lower taxes and transactions costs that come with long holding periods. Decisions based on intrinsic value calculations, especially DCF-based decisions, typically consider only events occurring within a 7 to 10-year horizon. At that point, a terminal multiple is applied to the contemporary earnings. This multiple is usually chosen to be conservative, but without considering fade rates and long-run declines in earnings growth, it is not clear what a truly conservative multiple looks like. Take railroads as an example. For the last 2 decades, railroad earnings have done extremely well, thanks to the combination of deregulation, operating efficiencies, and rising fuel costs that have enhanced the competitive position of trains over trucks. Taken together, these events have led to steadily higher earnings margins. But looking forward, there are long-term trends that are far less favorable. The economic transition of consumption from goods manufactured in concentrated industrial sites to services delivered locally will lower the demand for railroad services. Developments such as 3D printing will decentralize manufacturing and adversely affect transportation as a whole. Smart trucks that can travel in convoys without drivers will capture many of the current benefits of railroads while taking advantage of the shared rights of way that are the highway system and the ability to target more precisely the final local destination. None of these developments are likely to have a major impact in the next 7 to 10 years, but in the longer term, they will be important. A constant growth return model will take these factors into account. An intrinsic value model limited to the next 7 or 10 years will not. The return-based valuation also has limitations. First, given a market price, returns can be calculated going forward, and informed buy decisions can be made. Sell decisions must be made at prices chosen by other investors. Typically, in the Graham and Dodd tradition, this would be done by comparing intrinsic value to market price. But for franchise-based growth businesses, we do not have a usable estimate of intrinsic value. We could choose a level of calculated return, knowing that the expected return declines as the market price of the stock rises. Unfortunately, this approach provides a very inexact discipline. Our calculated benchmark returns, as in the CG case, are usually very insensitive to changes in market prices. If most of the return arises from growth, and predominantly organic growth, then doubling the market price might reduce the calculated benchmark returns by as little as 10%. The return approach improves buy decisions for franchise businesses. The sell decision for those stocks remains a thorny and intractable problem, given the fundamental difficulty of calculating intrinsic values for franchises businesses. It is not surprising, therefore, that value-oriented growth investors resort to rule-based and somewhat arbitrary sell protocols. Warren Buffett, for example, typically plans never to sell. Other value investors often use arbitrary limits on the multiple of sustainable earnings, e.g. 25 times, above which they will no longer hold franchises businesses. Second, the approach will not work for all growing franchises. Forecasting future returns, including capital gains, requires that the future be reasonably stable and predictable. Otherwise, estimates of growth rates cannot be made with any useful degree of accuracy. Franchise businesses growing at 15% or more per year cannot sustain those growth rates forever. Sooner or later, growth rates will decline to no more than a few percentage points above the long-term rate of the overall economy. Otherwise, as we have noted, one franchise business would take over the greater part of the whole economy. It is impossible to predict accurately when the inevitable transition to sustainable rates of growth will occur. It is also difficult to forecast the return impacts of shorter-term developments, such as better management, economic fluctuations, potential major acquisitions, or innovative competitor behavior. In these fluid circumstances, at least some competitive advantages may shift in unpredictable ways. As a result, attempting to estimate returns for these companies will be, in the language of Graham and Dodd, a speculation rather than an investment judgment. These opportunities will usually land in the too tough to call pile. In franchise investing, as in value investing more generally, it is critical to identify what is accurately knowable, and in the Graham and Dodd tradition, focus on those factors in making investment decisions. Example 3. WD-40. One way of tracking the evolution of our approach to value investing between the first edition of this book, written largely in 1999 to 2000, and the current edition, is to re-examine some of the investment opportunities that we analyzed then. For Hudson General, a classic Case A opportunity with asset value well in excess of earnings power value, there has been little change. But for franchise businesses like WD-40, our understanding of the valuation process has evolved considerably. We will re-examine WD-40 at separate dates to highlight developments both in the company and in our analytical process. First, we will look at WD-40 at the end of September 1998, when the annual report for FY 1998, ending on August 31st, became available. This snapshot revisits the principal valuation analysis of the first edition. Second, we will look at WD-40 in September 2000, a second date we considered in the first edition. The differences in valuations at these two times provide a useful measure of the additional details in our current approach. Finally, we will look at WD-40 in September 2018, when financial reports for the most recent fiscal year became available in order to demonstrate our new approach to contemporary valuations. WD-40 had been a one-product company for over 40 years until it purchased the 3-in-1 brand from Reckitt and Coleman in December 1995. The product WD-40 is a lubricant that unfreezes sticky screws, removes rust, dissolves adhesives, stops squeaks, and comes to the aid of the home-handy person or the machine shop professional whenever anything small needs to be lubricated or protected from rust. The name WD-40 means water displacement, 40th attempt, suggesting the trials and effort that went into development. The familiar blue can is practically ubiquitous in homes, factories, and repair shops in the United States, United Kingdom, and many other parts of the world. According to the company, 4 out of 5 American households have a can, and more people use WD-40 each week than use dental floss. While this may be good news for dentists, it leaves WD-40 with few untapped targets for new business in its domestic market. Through 2000, WD-40 had been an extraordinarily profitable company, consistent and high operating margins, 25 to 30%, net income margins, 15 to 18%, and returns on equity, 35 to 42%, even without adjusting for excess cash. But growth in the mid-1990s had been more difficult, dropping from around 10% a year to slightly more than 5%. Net income, always a more variable figure, held up until after 1995, when it also tailed off. WD-40 took 3 steps starting in 1995 to invigorate its growth. It bought 3-in-1. It internally developed TAL5, a more powerful lubricant that it sought to market to commercial users without success, and it purchased the Lava brand of hand soap from Block Drug in April 1999. It was too early from our 2000 perspective to say whether the last new effort would pay off, by which we mean if it would spur growth in sales and income, as well as maintaining the high level of profitability. Instead, we will focus initially on the financial numbers for the fiscal year ending in August 1998, before Lava entered the picture, and right from that vantage point. WD-40 contracted out the manufacture, packaging, and shipment of all its lubricants. In fiscal year 1998, it needed only 167 employees to support $144 million in revenues. Primarily a sales and marketing organization, it spent around 10% of its revenue on advertising and promotion. It had no secret formula for any of the lubricants and other products, nothing that Dow, DuPont, Exxon, 3M, P&G, Unilever, or any other firm with a modicum of competence in the chemical business could not duplicate. No patents protected these products. Yet WD-40 had for many years earned an exceptionally high return, however measured, as return on sales, return on assets, or return on equity. The company referred to WD-40 as a fortress, and one of its goals was to extend the fortress beyond the U.S. and U.K. markets. When the company, in order to comply with environmental concerns, switched its aerosol propellant to CO2, yes, that CO2, better than the ozone-depleting chemical it was previously using, it was able to pass on the increased cost without blinking. WD-40 had all the characteristics of a powerful franchise business, including, it seems, significant unexploited pricing power. Unlike Hudson General and Magna, we have to look at WD-40 as an earnings-generating machine for which growth creates value, and assets play a lesser role in valuation. In other words, WD-40 is likely to be a KC company for which current earnings power value significantly exceeds asset value. We need, therefore, to focus primarily on earnings power, growth potential, and the sustainability of current levels of profitability. we have to understand its strategic position. Where were the competitors who should have been entering into markets and stealing away customers or forcing WD-40 to lower its prices? If there were nothing magic in its lubricants elixir, what kept the challengers at bay? WD-40 as the reward of a well-conceived search strategy. In looking at a franchise business, we have to concentrate on the core enterprise that is the key locus of value creation, meaning that we start with an enterprise valuation rather than valuing only the equity. This begins with the total market value of WD-40's equity. At the end of September 1998, WD-40's common stock was trading at $26.50. The fully diluted number of shares outstanding as of August 31, 1998, was 15.7 million, for a total market value of $416 million. From this figure, we must subtract the value represented by WD-40's net cash holdings of $13 million. That leaves the value of the ongoing enterprise, what we would have had to pay for the company at the current market price, minus the value of the net cash acquired, which is cash minus debt, at $403 million. To this, we should next add the cost of legacy liabilities, such as unfunded pension liabilities, that we would in principle have to pay off along with the debt in order to acquire an unencumbered claim on the underlying business. We should subtract the offsetting value of non-core assets, such as investments in unrelated enterprises like low-income housing that could, again in principle, be sold to pay off debt or legacy liabilities. For WD-40, the net total is near zero, so we will ignore these adjustments. At the end of September 1998, we would have had to pay $403 million to acquire the core enterprise of WD-40 at then prevailing market prices. For our $403 million, we would acquire a business that generated roughly $34 million of operating earnings before interest and taxes, or EBIT, in FY 1998. With an average tax rate of roughly 36%. This falls to around $22 million in potential after-tax earnings, a 5.5% return on our $403 million investment. Using a more traditional metric, the WD-40 enterprise was trading at 12 times EBIT, $403 million divided by $34 million, or 18 times after-tax earnings, $403 million divided by $22 million. By both measures, WD-40 was a relative bargain compared to other contemporary investments. In September 1998, the overall stock market, including non-franchise businesses, was trading at 22 to 23 times earnings. However, by longer-term historical standards, where the average P to E ratio was 17 to 18 to 1, WD-40 was less attractive. In the year prior to September 30th, 1998, WD-40's stock price was flat to slightly down in the midst of a generally rising stock market. Overall, therefore, WD-40 was slightly disappointing, slightly cheap for a growing franchise business, and with a small market cap of $416 million not closely followed by financial analysts. On the other hand, its product was widely known and admired. WD-40 might well have been worth looking at in an inflated market environment with few obvious bargains, but we should not be surprised if it turned out to be fairly valued. It was not an obvious bargain, unlike Magna International in March 2009. The WD-40 franchise. The first step in evaluating any franchise business is to assess the nature, magnitude, and sustainability of the business's competitive advantages divided by barriers to entry. Of the three fundamental sources of competitive advantage, we have already addressed the question of proprietary technology. WD-40 had no significant patents, learning curve advantages, or proprietary process technologies. What WD-40 did enjoy was a significant degree of customer captivity. Customer loyalty, built up over many years of advertising and customer satisfaction, ensured that a competitor would have a difficult time persuading users to try something new. Here, the absence of technological change benefited WD-40. Even WD-40's own new lubricant, TAL5, did not represent a sufficiently large improvement over the established product to attract customers. Relative to the price of the product, search costs were strikingly high. A can of WD-40 typically sold for under $5 and lasted for many years. Trying an alternative product at a potential savings of $1 per can would have minimal appeal since a single can lasted so long. The benefits of repeated purchases of a superior alternative were limited by the low replacement frequency. If an alternative proved unsatisfactory, then the consumer's loss would be the full $4 purchase price. Even with a success probability of 75%, this was a losing proposition. An expected gain of 75 cents, 75% times $1, compared to an expected loss of $1, 25% times $4. Beyond this marginal gain at best, the time and trouble of finding an alternative would have to be considered. The economics for retailers were likely to be even worse. The 20% discount minimally necessary to attract WD-40 customers inevitably meant a lower retail margin, or an even greater wholesale price reduction than 20% by the entrant brand. Given the unlikelihood that a competitive entrant would attract large numbers of WD-40 customers within a reasonable period of time, any resulting investment in promotion and shelf space at the retail level was almost certain to be unprofitable. The absence of retail support for alternative brands reinforced WD-40's customer captivity. Finally, WD-40's market saturation meant that only a relatively few potential customers were not already WD-40 users. Their number, even if they were freely available targets for new entrants, were likely to be too small to support the fixed costs the newcomer would have to cover. These hurdles for a potential competitor led naturally to the most important source of competitive advantage, economies of scale. In order to enter each separate geographic market for WD-40, an entrant would have had to establish a local sales and advertising presence sufficient to compete with WD-40. Advertising and promotion expenses for WD-40, with basically a 100% market share, were 10% of sales. These costs were fixed for each geographic market regardless of sales. Suppose the market in southern Florida was $30 million per year. Then the 10% fixed marketing and sales costs would be $3 million. If an entrant succeeded in capturing a 25% market share at a price 20% below WD-40's, its sales would be $6 million, 1/4 of a market, of $24 million in revenue at the 20% lower price. The $3 million fixed overhead would then consume 50% of sales revenue. WD-40's cost of goods sold, its variable unit production and distribution costs for local contractors, was at least 40% of sales. If the entrant had those same costs with a 20% lower price, then its cost of goods sold would be 50% of its revenue, 80% of WD-40's unit price divided by 40% of WD-40's unit price. Together, the fixed local sales overhead plus cost of goods sold would consume 100% of the entrant's revenue, with nothing left for product management, administrative overhead, or local management supervision. This opportunity was not an economically attractive proposition for any entrant with a calculator or a spreadsheet. Looked at another way, suppose an entrant could be economically viable at 30% market share, and that the entrant would capture 0.5% market share per year, an optimistic figure for a product like WD-40 with a low price, low purchase frequency, and high search cost. Reaching a 30% market share would take 60 years. A 60-year path to economic viability would likely deter any rational potential entrant and bankrupt any irrational one. The strength of WD-40's economic franchise depended paradoxically on the small size of its market. Remember, the best defended monopoly is a single store in a town too small to allow for a second one. WD-40's existing market looked in 1998 very much like a one-store town. The financial history provides strong support for this argument. By 1998, which is our vantage point for this analysis, WD-40 had enjoyed immunity from entrants for over 40 years while earning outsized returns on invested capital. On August 31, 1998, WD-40 had a book value of equity of $55 million, including $13 million in net cash and an additional $3 million invested in low-income housing, which at the time provided tax advantages. The book value of equity investment in the operating business was only about $40 million. Net operating income after taxes of $22 million represented a 55% return on equity. In theory, this higher return should have attracted swarms of competitors. The fact that no successful entry took place over 40 years indicates that powerful barriers to entry were in place. Valuing WD-40 in 1998. Earnings power for WD-40. For a business like WD-40 with a sustainable franchise, the reproduction costs of the assets play only a secondary role in determining intrinsic value. But it is also true that earnings power values by themselves do not determine the attractiveness of a franchise investment. In contrast to competitive businesses, growth in a franchise may add significant value. Nevertheless, estimating the earnings power is the proper starting point for evaluating franchise businesses. Table example 3.1 presents a history of that relevant financial data for WD-40 from 1990 through 2002. Throughout this period, revenues rarely declined. Even in the recession year of 1991, revenues fell by only about 1% and then quickly recovered in 1992. Given the absence of cyclical variation, current year revenues should be sustainable revenues. Margins were also highly stable and do not appear to vary with the business cycle. In 1991, operating margin actually rose. There were year-to-year margin fluctuations that should be averaged out to calculate sustainable margins. From 1990 to 1998, operating margins averaged 27%. There was a slight downward trend in margins during this period, with margins in 1998 particularly low. We should be careful not to use the fact that margins in 1999 and 2000 continued to drop since that information was not available in 1998. However, it is notable that the decline seems to have coincided with a rising concern regarding stagnant sales in the early 1990s that led management to develop TAL5 and acquire 3-in-1. Increased marketing expense to boost sales growth was reflected in rising levels of overhead expense relative to sales, a large part of the reason for the declining margins. If we believed that this increase in marketing spend was permanent, then sustainable margins from 1998 going forward would be well below the historical average of about 27%. If we thought the higher costs were temporary, then the historical average should apply. Since we were uncertain, we split the difference and used an estimated sustainable earnings margin of 25%, halfway between 27% and the more recent levels below 24%. Thus, our 1998 estimated sustainable operating earnings before accounting adjustments was $36 million, 25% of sustainable revenues of $144 million. Few accounting adjustments to this number were required. WD-40 took only a single exceptional charge of $12.6 million between 1990 and 1998, the result of a litigation loss in 1994. This averaged out to $1.4 million per year over the 9 years. Counterbalancing this loss, Depreciation charges between 1990 and 1998 regularly equaled or exceeded total capital expense. Depreciation seems to have exceeded any reasonable estimate of replacement capital expense by at least $1 million per year. Since this second adjustment is largely protected from income tax by the depreciation tax shield, it almost exactly offsets the post-tax cost of the average write-down of $0.9 million, 100% less the 37% corporate tax rate times a pre-tax cost of $1.4 million. Our sustainable operating earnings of $36 million pre-accounting adjustments were slightly above post-adjusted figure. The average rate of corporate income tax incurred in the 5 years from 1994 to 1998 was roughly 37%. If we assume that this was a sustainable future tax rate, then the after-tax earnings power for WD-40's core franchise business in 1998 was $23 million, 63% of $36 million. This represented a 5.7% earnings return on the $403 million cost of buying the core business. Earnings Power Value 2. At this point, in the first edition of the book, we proceeded to calculate earnings power value, just as we have done in this edition for Magna International and Hudson General. We simply divided the $23 million earnings power by the cost of capital appropriate to an investment in the core WD-40 business. The cost of capital is the cost of voluntarily attracting the funds necessary to support the business, a weighted average of the cost of attracting both cheap debt financing and expensive equity financing. The weights in question should reflect the mix of actual financing for a firm's operations going forward, with the notable exception of companies that are overly reliant on debt. In these cases, the cost of the debt should properly include the potential cost of debt-related impairment of company operations, including the potential cost of bankruptcy. This cost is difficult to calculate and often overlooked. As a result, the calculated cost of capital for firms with a heavy reliance on low-cost debt will be inappropriately low. The standard solution to this problem is to reduce the amount of debt from actual historical levels to a level at which it would not be expected to significantly impair firm operations. In many finance contexts, this is assumed to be an optimal level of debt, e.g., 20%, as opposed to an actual debt level of 80%, with an associated optimal level of equity, e.g., 80%, as opposed to an actual level of 20%. Some finance practitioners recommend applying a similar ideal capital structure and calculating cost of capital for firms with too little debt. But in this case, the true cost of debt is not being ignored, and there is no such hidden cost to too much equity. WD-40 had generally been all equity financed, often with negative net debt, positive net cash. Moreover, there was little indication that this would change in the future, short of significant activist intervention. Thus, for WD-40, the weighted average cost of capital was the cost of equity financing. The cost of equity financing in 1998 lay between the contemporary cost of slightly risky, say, BAA debt, and the cost of venture capital funding, typically the most expensive source of equity. In the fall of 1998, this range ran from 7 to 15%. Given its highly stable economic position and all-equity financial structure, WD-40's cost of equity should have fallen near the bottom of this range. Thus, our estimate of the cost of capital for WD-40 would have been roughly 8%, producing an earnings power value of $288 million for the underlying operation, $23 million divided by 8%. To this we must add the value of net cash and other extraneous investments of $16 million for a final earnings power value of $304 million for WD-40's equity. This figure corresponds to a value per share of $19.36, $304 million divided by 15.7 million shares, which was below the market price of $26.50. An orthodox Graham and Dodd investor would not have invested in WD-40, but for businesses such as WD-40, given the powerful nature of its franchise, growth does create incremental value. This added value might make an investment attractive for a value investor willing to include value-creating growth in the investment decision. The value of growth for WD-40. In the first edition of this book, we devoted 3 short paragraphs to the possibility of profitable growth, for which we used a highly abbreviated DCF model. First, we noted that WD-40 paid $1.28 per share out of its earnings of $1.40. We assumed this amount captured the likely future sustainable cash distributions out of sustainable earnings, roughly also $1.40 per share, since net share buybacks were negligible. Next, we estimated without detailed analysis that recent earnings growth rates of about 3% would be sustainable in the future, and that with a constant payout ratio, dividends would grow with earnings. Finally, with our 8% cost of capital and 3% growth rate, we capitalized the $1.40 per share payout at 20 times, 1 divided by open parenthesis 8% minus 3%, close parenthesis. This yielded a per-share value of $25.60, still slightly below the market price of $26.50. The shortcomings of this calculation then and now are its painful uncertainty. If the growth rate in earnings were 4.5%, a mere 1.5% off our 3% estimate, a figure closer to the long-term earnings growth rate, then the capitalization factor would have been 28.5, 1 divided by 3.5%, for a per-share value of $36.48, a nearly 30% margin of safety given the contemporary price of $26.50 per share. On the other hand, an earnings growth rate of 1.5%, equal to the most recent few years, would lead to a multiple of 15, 1 divided by 6.5%, for a price of under $20 per share, leaving WD-40 a truly unattractive investment. As we pointed out at the beginning of Chapter 8, this indeterminacy is fundamental to growth stock evaluation. In order to make useful growth stock investment decisions, we should look at returns, not values. WD-40 returns. Analysis of sustainable future returns begins with the future cash return. This is the quantity of earnings actually distributed to stockholders out of the 5.7% sustainable earnings return that we calculated before. This figure itself depends on the distribution policy of WD-40's management. In 6 years, through the end of August 1998, WD-40 distributed a net $18 million per year on average to shareholders in dividends minus, in this case, net equity sales. Net income averaged $21 million per year after making appropriate adjustments for overdepreciation and the one-time charge in 1994. Net cash remained roughly constant. The resulting 86% payout ratio was financed from earnings and therefore likely sustainable. A payout of 86% of the 5.7% sustainable earnings return represented a roughly 5% cash return going forward to investors in WD-40 stock purchased on September 30th, 1998 at $26.50 per share. To this, we must add the returns from growth, which would have arisen from 2 basic sources. 1, organic growth in sales and earnings of WD-40's existing product lines, distribution arrangements, and productivity improvements. And 2, returns to active and reinvestment initiatives such as the purchase of $15 million of 3-in-1 products in December 1995. We will consider each of these sources of the value of growth in turn. Organic growth returns. Table example 3.2 shows historical nominal growth rates in WD-40 revenues and earnings relative to overall U.S. inflation rates. For the period prior to the acquisition of 3-in-1, 1980 to 1995, nominal revenues grew by 8.4% per year. Real sales grew by 4.5% per year, and net income grew by 7.4% per year. Growth in sales was entirely internally generated by a combination of rising organic demand, expansions to new geographic markets financed out of current income, and for profits from daily improvements in operating efficiency. Capital investment was minimal, and the one active investment initiative, the development of TAL5, was a flop. We considered this growth organic in the sense that it arose naturally in the ordinary course of doing business. Profit growth was slightly below revenue growth, but that was largely attributable to developments prior to 1985. If the extraordinary spending on TAL5 were to be eliminated, the historical growth of net income in tandem with revenue should resume. The question then is, what would revenue growth going forward look like? And to answer that, we needed to focus on the underlying determinants of WD-40's revenue growth. Throughout the late 1990s, WD-40 exports from the US, UK, and Australia to emerging economies rose sharply. The demand from those areas was in no sense saturated, meaning that WD-40's growth would not be limited by increases in the developed economies of Europe and North America. WD-40 appealed to households across the income spectrum and would not be greatly affected by secular changes toward greater income inequality. On the other hand, WD-40 was a product rather than a service and would suffer from the global trend in consumption away from goods and towards services. Taken together, these forces suggested that demand for WD-40 going forward would grow slightly more slowly than global GDP, perhaps 4% in real terms, compared to an expected real GDP growth of 5% from 1998 going forward. This GDP figure would correspond to the population growth of 1.5% per year and global productivity growth of 3.5%. On top of this real growth, global inflation was likely to run at about 1.5%, continuing a deceleration that began in the early 1980s. Nominal GDP growth of 6 to 6.5% per year should translate into growth in demand for WD-40 of at most 4.5%. That would closely resemble the pre-1995 historical growth rate of 4.5%. If we allow for the further possibility that a fraction of the recent decline in margins prior to 1998 would be permanent, an organic growth rate of WD-40 net income of 4% a year would be a reasonable estimate. The investment required to support this organic growth would consist almost entirely of working capital. WD-40 outsourced all its manufacturing and distribution. Historical accounts receivable and inventory had amounted to roughly 20% of sales, partially offset by accounts payable and accrued liabilities equal to 6% of sales. Using these ratios, net working capital of 14 cents would be required for each extra dollar of sales. The 1998 base level of $144 million in sales growing at 4.5% would mean an extra $6.5 million in sales. The additional net working capital required would be about $1 million, 14% of $6.5 million, or about 4.5% of sustainable 1998 earnings of $21 million. If 86% of earnings continued to be distributed to shareholders and 4.5% was needed to support organic growth, That would leave roughly 10% of earnings for active reinvestment. To sum up, on top of the cash return of 5%, organic growth should contribute a further 4% annual increase in value, a total of 9%, while leaving 10% of earnings to generate further value through active reinvestment. Active reinvestment. After distributing $19 million to shareholders, 86% of $22 million, and using $1 million to support organic growth, management would be left with $2 million sustainable earnings per year for active reinvestment. In the case of WD-40, this money had recently gone to the acquisition of new product lines. Prior to 1998, the sole acquisition had been 3-in-1 in December 1995. Including acquired debt, WD-40 paid $16 million for brand value and other intangibles, plus a small amount of inventory. Assuming that WD-40 could employ these assets with the same effectiveness as had Reckitt and Coleman, the prior owner, incremental 3-in-1 revenues and earnings for WD-40 should be the same as they were before the sale. For 1994 and 1995, Reckitt and Coleman reported average 3-in-1 sales of roughly $12.5 million and average operating income after amortization of roughly $6 million. The reported $6.5 million in cost included cost of goods sold and direct marketing cost equal to 15% of sales with no provision for other overhead. For a product very similar to WD-40, the implied operating margins of 48% seems improbably high compared to WD-40's pre-1995 operating margins of 27%. With 3-in-1 operating margins adjusted to that level, the average operating income acquired by WD-40 would have been $3.4 million, 27% of $12.5 million. At a tax rate of 37%, after-tax incremental profit would have been $2.1 million, a roughly 13% annual return on WD-40's $16 million investment before attributing any value to growth in 3-in-1 revenues and profits. If 3-in-1 were indeed similar to WD-40, then organic growth should add considerably to the returns from the acquisition. However, the limited history published before the deal revealed flat to slightly declining sales and margins. It seems realistic to ignore growth in evaluating the 3-in-1 acquisition. The 13% return on investment, even with no growth, was well above a likely cost of capital of 8 to 9%, similar to WD-40's. This return represents a value creation factor of 1.5, 13% divided by 8.5% on the acquisition. If this transaction reflected WD-40's skills in actively investing retained earnings, then each dollar reinvested should create $1.5 of value for WD-40. Thus, the $2 million in sustainable reinvested annual earnings would add $3 million in annual value, a further return of about 0.75% on the $403 million purchase cost of WD-40. For this reinvestment scenario, the total return on an equity investment in WD-40 at $26.50 per share would be almost 10%, a 5% cash return, 4% from organic growth, and 0.75% from active reinvestment. The low level of this active reinvestment return is due to the low level of actively reinvested earnings. Compared to WD-40's cost of capital of 8%, this leaves roughly 25% as the margin of safety on returns. In the late 1990s, average equity returns in the U.S. equity market were around 6%. The market multiple of sustainable earnings was roughly 25 times, a real earnings return of 4%. Inflation added another 1.5% to reach nominal estimated returns of 5.5%. Alternatively, we could have estimated the market return from cash payouts plus overall growth. Average payouts on U.S. equities were 2%, with nominal growth adding perhaps another 4.5%. The total prospective nominal U.S. returns were 6.5%. Averaging the two gives an estimated market return of 6%. In comparison, a return close to 10% on low-risk equities such as WD-40 would have seemed attractive. But value investors should be wary of these kinds of return comparisons in euphoric markets like that of the late 1990s. Short-term contemporary return comparisons are relative value comparisons. True value investors should compare the 10% return to the long-term cost of capital estimate embodied in our 8% figure. Even with that caveat, a careful accounting for growth in terms of returns reveals that WD-40 in late 1998 was a much more attractive opportunity than indicated by the abbreviated DCF analysis in our first edition. This return approach turns out to have been remarkably accurate. Table Example 3.3 presents realized returns to a WD-40 equity purchase on September 30th, 1998, over the following 5, 10, and 15-year periods. It also includes estimated returns for the period, which we computed before looking at the actuals, no peeking. The only substantial difference is in the 10-year period that terminated on September 30th, 2008, in the middle of the financial crisis. Over the entire 15 years, the S&P 500 index returned slightly less than but close to our 6% estimate, which by historical equity return averages is not what Graham and Dodd would have regarded as a satisfactory return. However, these figures overstate the true margin of safety of the WD-40 investment since the SP returns are unusually low. They highlight the danger of relative return decision-making, particularly when investing in richly valued markets. A second piece of these return comparisons also overstates the attractiveness of a WD-40 investment in 1998. Looking forward, there was a low, but not zero probability that changing economic conditions would undermine WD-40's franchise position. As we discussed before, barriers to entry into WD-40's markets appeared formidable. The retail infrastructure through which WD-40 sold its products looked highly stable. Internet-based retail, whose consequences we will discuss later, did not yet appear as a threat. Technology did not seem likely to undermine the utility of WD-40's products, which by 1998 had enjoyed an unchallenged market position for roughly 50 years. If we use as a rule of thumb that future franchise life should equal existing franchise life, we would have estimated a franchise fade rate for WD-40 of 1.4%. 72 divided by 50 years to get a franchise half-life. Our 2% margin of safety slightly exceeded this potential rate of loss, but taking this fade rate into account would have made WD-40 a significantly less attractive investment. As the future unfolded between 1998 and 2013, the WD-40 franchise remained intact. The temptation, therefore, is to treat the fade probability as zero and to accept the realized returns in Table Example 3.3 as an accurate measure of the likely return on the original WD-40 investment. The ex-ante odds certainly favored this outcome. With a half-life of 50 years, WD-40's franchise was unlikely to be undermined by events within 15 years. There was, however, an undeniable element of luck in this outcome. Today, as retail through the internet threatens to become the dominant marketing channel for WD-40, the future of WD-40's franchise looks far more uncertain than it did in 1998. This evolution might easily have arrived 5 or 10 years earlier. The fact that it did not may represent good fortune for WD-40, but it was hardly inevitable. Thus, the returns in Table Example 3.3 do not fully reflect the cost of franchise fade, and to that extent, overstate the return to the 1998 WD-40 investment. WD-40 on September 30th, 2000. From $26.50 on September 30th, 1998, the price of a WD-40 share fell from $21.88 on September 30th, 2000. At a time when the U.S. stock market as a whole was doing extremely well, the annual return to a WD-40 investment over these 2 years was negative 9%. A stock price decline of 9% per year was partially offset by dividends. In the near term, the 1998 investment in WD-40 would have been a disappointment. One of the key assumptions underlying our 1998 valuation turned out not to be accurate in the short run. We assumed that management would not persist in the value-destroying pursuit of growth, whether through acquisitions like 3-in-1 or internal developments like TAL5. We were wrong. In April 1999, WD-40 acquired Lava brand soap, a heavy-duty hand cleaner. A year later, it bought Solvol hand cleaner. In April 2001, management paid $72.9 million for 3 household products: 2,000 flushes, X14, a toilet bowl and hard surface cleaner, and Carpet Fresh. These acquisitions, the results of a policy of unfocused growth that became apparent between 1998 and 2000, were both more expensive and less closely related to WD-40's existing products than the 3-in-1 acquisition. The consequences are evident in the operating performance data in Table Example 3.1. From FY 1998 to FY 2000, both gross and operating margins declined noticeably, while revenues increased only slightly. The decline in tax rates moderated the drop in net income, which still fell from $22 million to $21 million. Payout ratios continued to be high, at least until the April 2000 acquisition. But net cash fell by $24 million from $16 million of net cash to $8 million of net debt, so that high payouts were sure to be subject to balance sheet pressures in the future. Management continued to stress the pursuit of growth. There were indications, even prior to September 1998, that this might happen. As we noted before, operating margins had declined from roughly 28% in FY 1994 and FY 1995 to 24% in 1998, as marketing and overhead expenses increased relative to sales in pursuit of more rapid revenue growth. These efforts had been disappointing. After an earlier unsuccessful growth policy from 1980 to 1985, WD-40's management had refocused on operational efficiency, and margins had recovered. In our valuation, we assumed something similar would happen going forward from September 1998. Our error in making this judgment naturally raises the question of whether, at the reduced price of $21.88 in September 2000, WD-40 remained a sound investment. If management persisted in pursuing ill-focused growth, earnings power was likely to fall from $22 million to $20 million. The cost of acquiring WD-40 for its operations was now $340 million. 15.6 million shares times $21.88 per share, plus $8 million of net debt. The decline in the capital necessary to buy WD-40 made the sustainable earnings return, 5.75%, very close to the 5.7% earnings return in September 1998. The payout ratio in 2000 was actually more than 100% of earnings, which did not appear sustainable. Let us assume that payouts decline from 86% of earnings power to 76% of earnings power. This yields a 4.5% cash return. Organic growth should continue to be 4% per year, with an investment cost equal to roughly 4% of earnings. This would leave 20% of earnings for active reinvestment, 100% minus 76% payout, minus 4% organic growth investment. The quality of the active investment had undoubtedly dropped by between 1995 and 2000. It seems unlikely that acquisitions in the areas of toilet, hand, and rug cleaner would be as accretive in value as the 3-in-1 acquisition. Exactly how much value would be destroyed per dollar invested would have required a detailed acquisition by acquisition analysis, similar to what we did for 3-in-1. But let us simply assume that each dollar invested produces only about 50 cents of value. Then, the $4 million of actively invested earnings, 20% of $20 million, produces $2 million of additional value, 50% of $4 million. That in turn represents a further 0.6% return on the $340 million market purchase price, $2 million divided by $340 million. A rough estimate of the total return from an investment in WD-40 in 2000 is thus 9% per year, 4.5% cash return, 4% organic growth, and 0.6% active investment return. The decline in management performance was largely balanced by the decline in WD-40's market price. Meanwhile, the overall level of U.S. stock prices had risen, lowering a reasonable estimate of the S&P 500 return from 6% to about 5%. In relative terms, WD-40 had by September 2000 become slightly more attractive. But in critical absolute return terms, with its likely fade rate taken into account, WD-40 now represented a return just equal to its cost of capital, leaving no margin of safety. As things worked out, WD-40 in the long run outperformed these reduced expectations. At the end of 5 and 10 years, actual returns were almost exactly 9%. The 15-year return was over 13%. In the long run, WD-40 regained its touch by returning to what it did best and abandoning its unfocused growth efforts. From 2012 to 2015, even as WD-40's revenues grew by only 3.3% per year, close to the organic growth rate which had slowed slightly with the decline in global GDP growth, its operating margins rose from 15.1% to 17.3%. By 2018, the operating margins were 19.2%, and payouts were averaging over 100%. These were financed from a rising level of net debt. This change illustrates an essential point about franchise investing. The long run matters, and in the long run, unless there is strong evidence to the contrary, stability is more likely than change. WD-40 in 2018. On September 28, 2018, the last trading day in September, WD-40 closed at a price of $172.10 per share. Operating margins appear to have stabilized at 19%, and revenues were $409 million. As a result of a dramatic recent reduction in corporate tax rates, corporate taxes in 2018 were only slightly above 12% of net income. In the long run, corporate tax rates appear unlikely to continue at such a low level, if only because U.S. federal tax rates reductions will be partially offset by rising state corporate income tax rates. Because the trend toward lower corporate income tax rates has been long-lived and global in nature, we will assume a sustainable corporate tax rate of 20%. These figures produce an earnings power estimate for WD-40 in 2018 of $62 million, $409 million times 19% times 80% after tax. Given management's return to its long-standing policy of distributing a large fraction of earnings and to focusing retained earnings on improving core business operations, we will assume that all earnings, aside from those required to support organic growth, are either distributed to stockholders or, if actively reinvested, earn a return equal to WD-40's cost of capital. In terms of value delivered to shareholders, these alternatives amount to the same thing. Organic growth, which given the low level of active reinvestment should have tracked overall growth in the past few years, appears to have declined from 4% to roughly 3% per year, mirroring slowing global economic growth in both developed and developing countries. At 3% organic growth, WD-40's 2018 sales growth should be $12.3 million per year, 3% of $409 million. Since each dollar of extra revenue continues to require about 15 cents of net investment, $2 million of retained earnings must be devoted to supporting organic growth. That leaves $60 million of sustainable earnings for distribution to investors. The cost of buying WD-40's core business at the end of September 2018 consists of $2,392 million in equity, $172.10 times 13.9 million shares outstanding, plus $37 million in net debt, for a total enterprise value of $2,429 million. The $60 million sustainable annual distribution to shareholders then represents roughly a cash return of about 2.5%, $60 million divided by $2,429 million. Adding 3% for organic growth yields a total return of 5.5%, since we are assuming that active reinvestment will be negligible. This figure is clearly below our long-run cost of capital of 8%, meaning that intrinsic value is below market value, and the 3% organic growth return exaggerates the true organic growth return, further reducing our true return. In addition, the shift of retail to the internet has almost certainly narrowed WD-40's moat. Rival products no longer need to pursue the difficult and costly process of in-store placements and distribution. They can now appeal directly to masses of consumers. At the same time, online user reviews should provide some measure of assurance about the quality of each new rival product. Finally, internet retailing greatly facilitates price comparisons and increases price competition. As these changes become embedded in markets and consumer behavior, the potential for WD-40 franchise erosion should rise markedly. In our terminology, fade rates could well increase from 1 to 1.5% per year to as much as 2.5 to 3%, from a franchise half-life of 50 years to one of 25 to 30 years. With no margin of safety left in the current WD-40 stock price, there is no protection against franchise fade of this magnitude. At the end of 2018, WD-40 is clearly overvalued. The technological innovations that can threaten even a well-entrenched franchise like WD-40 may emerge not from changes in product improvement or process technology, but from the infrastructure of sales and distribution. Example 4. Intel. By any measure, Intel is one of the great success stories in business history. We first wrote that sentence in the first edition of this book in January 2000, when Intel, which had been founded in 1969, had a market capitalization of $275 billion. It stood at the pinnacle of the semiconductor industry, which was to the world economy in the last quarter of the 20th century what the railroads had been to the 19th century, and electricity and automobiles to the early 20th century, the great engine of growth and productivity. In 1999, Intel sales were $29 billion, having grown from $1.4 billion in 1985 a compound annual rate of roughly 24%. Profit margins on sales had averaged more than 20%, and returns on equity, properly measured, more than 40% during those 15 years. Buying Intel stock at the IPO in 1971 would have been a stroke of genius. So would an investment 10 years later in 1981, and 10 years after that in 1991. 27 years later, at the end of 2018, Intel remained an outstanding, if not the outstanding company in the semiconductor industry. Sales in 2018 exceeded $70 billion. Margins on sales and on equity, again properly measured, were both over 30%. Yet Intel's market capitalization on December 2018 was only $218 billion, well below its January 2000 level. An investment in Intel stock over those 19 years would have produced an average annual return of just 2%. Notwithstanding the company's extraordinarily strong long-term performance, there were many times during these years when an investment in Intel would have been a disappointment. The critical question is whether the value investing process and the valuation tools we have developed in this book can enable a value investor to navigate successfully the turbulent waters of a stock such as Intel. This chapter attempts to provide an answer by applying the full range of those tools to a decision to invest in Intel at several critical points in its history. For every decision point except the most recent, we have the advantage of being able to compare our estimated returns with those actually realized by an investor, a potentially chastening experience for everyone who makes predictions. Intel history, the very short version. The series of events that gave birth to Intel read like a chapter from Genesis. In the beginning was Bell Labs. There, in the late 1940s, John Bardeen, Walter Brattain, and William Shockley invented the transistor, a solid-state replacement for the vacuum tube that had been a key component of the ENIAC generation of computers. The three earned the Nobel Prize for their efforts in 1956. In that year, Bell Labs begat Shockley Laboratories, as Shockley left to set up his own firm. 1 year later, 8 of Shockley's best engineers departed to start a new firm with the financial backing of Sherman Fairchild. And so Shockley Laboratories begat Fairchild Semiconductor. At Fairchild, Robert Noyce managed to combine multiple transistors on a single piece of silicon, inventing what became known as the integrated circuit. Fairchild, by contrast, began to disintegrate as talented employees left to strike out on their own. In 1967, Fairchild begat National Semiconductor when Charles Spork founded this new firm. 1 year later, Noyce and Gordon Moore, head of research and development, decided it was time for them to leave, frustrated that their most promising innovations seldom came to fruition. They made a telephone call to Arthur Rock, a venture capitalist before the term was invented, who raised enough money in 2 days for them to start on their own. Thus, Fairchild Semiconductor begat Intel. Intel's initial business was designing and manufacturing computer memory chips. Although it developed its first microprocessor, the 4004, in 1971, the company's bread and butter was integrated circuits that replaced magnetic cores as the memory components of mainframe computers. The chips were smaller, faster, and cheaper than magnetic cores. These three virtues, which became the dynamic behind continual innovation and growth in the computer and related industries, made the memory business very profitable for Intel. The founders had not discovered the particular technology that made that early generation of memory chips successful, nor was Intel the only company in the neighborhood, soon to be known as Silicon Valley, able to produce them. But it successfully combined product design, process engineering, and customer service so that it quickly emerged as the largest player in the memory chip game. Fairchild Semiconductor, from which both the engineers and the inventions had sprung, became less significant. In 1971, Intel raised $7 million by selling 300,000 shares in an IPO. It lost money on its operations in its first year, but then began a succession of profitable years that lasted until 1985. The company flourished by turning silicon, an inexpensive raw material, into valuable and essential finished products, memory chips, and later microprocessors. It accomplished this alchemy through the organized application of human capital in the form of scientific and engineering knowledge. We will telescope the first 3 decades of Intel's history into a few sentences. It made a lot of money in the 1970s on memory chips, even though it was often not the market leader or the most efficient producer. Around 1980, one of its microprocessors, the 8088, was chosen by IBM to be the central processing unit of the soon-to-be-launched IBM personal computer. At the same time that the PC revolution took off, Intel started to lose money on its memory chip business. Large Japanese conglomerates like Hitachi and Fujitsu beat Intel in every aspect of the dynamic random access memory game. They produced better chips, fewer duds, more cheaply, and then sold them for less money to manufacturers with whom they had worked more closely. After considerable soul-searching, Intel's history was interwoven from birth with that of the memory chip. Gordon Moore and Robert Noyce decided in 1985 to abandon the memory business. Since then, Intel has concentrated on microprocessors, both the original PC chip and its much more powerful successors, and on a range of other processors for network, industrial, and computer uses. The company has been continually profitable since it left the memory chip period in the mid-1980s. It has continued to grow, although not at the rate as in its early years when the silicon world was young. Throughout its history, Intel has invested heavily in developing its intellectual capital. Its R&D expenses averaged over 11% of sales for the period 1971 through 1998, and Intel defended its intellectual capital. It went to court repeatedly to contain rivals and former employees when it thought they were infringing on its patent-protected domains. Intel's giddy success in growing its business and keeping it profitable, with minor exceptions, is apparent from a few numbers and charts. Table Example 4.1 and Figure Example 4.1 display these results. In the figure, the scale is logarithmic. Each horizontal bar represents a tenfold increase from the line below. Several aspects of this history are common to many rapidly growing franchise businesses like Intel. They make Intel a particularly useful example for illustrating how to value such opportunities. First, new industries, especially those in high technology, are far from stable. Intel has never been WD-40. It began life as a maker of memory chips, but this episode was cut short by the entry of powerful global competitors with equivalent technology. At inception, the memory chip market was small and required highly specialized expertise. Under these circumstances, early entrants, such as Intel, enjoyed temporary advantages. They had a head start in moving down the learning curve to produce cheaper and more reliable chips. In the confines of the small initial market, they possessed significant scale advantages in R&D, marketing, and distribution. Finally, they were well positioned with customers who depended critically on a reliable supply of high-quality memory chips. For these customers, turning to untried alternative suppliers was highly risky. As a result, early entrants were protected from competition by strong customer captivity. However, as the market grew, the technology became more widely available and customers more sophisticated. Early competitive advantages dissipated. A larger market created more room for entrants to achieve viable scale at relatively low market share. Technology diffusion eliminated any proprietary, learning-based supply advantages. Increasing customer sophistication reduced customer captivity. The consequence, as Intel experienced, was intense global competition from a number of highly efficient firms. The easy profitability of Intel's early years could not be sustained. By 1985 and 1986, Intel was suffering serious operating losses. Intel survived this change, unlike many memory chip makers, due to a number of fortunate circumstances. At the time that memory chip profitability disappeared, Intel had a significant side business making microprocessors for the IBM PC and clone machines. By the mid-1980s, it had become, along with Microsoft's MS-DOS operating system, the personal computer industry standard. Second, Intel had sufficient resources to support a transition from memory to microprocessor chips. Third, Intel had a brave and visionary management that abandoned not only its now non-viable memory chip business, but also a promising initiative in parallel computing microprocessors in order to focus intensely on PC microprocessor chips. Investments in less favored memory chip firms would have not earned Intel-like returns. As a first step, investing successfully in nascent, rapidly growing businesses such as Intel requires both highly specialized knowledge of the relevant industry economics and management capabilities, or extremely good luck. Even after making the transition to PC microprocessors, Intel's success, although it looks inevitable in retrospect, was hardly guaranteed. Achieving a sustainably dominant position in the microprocessor market depended both on the nature of that business and the skill with which Intel's management addressed opportunities. If the microprocessor market were not to follow the path of memory chips, it would have to possess several distinct characteristics. First, as semiconductor technology advanced, the complexity of memory chips did not increase proportionately. Manufacturing leading-edge memory chips did not require steadily increasing R&D expense. In contrast, the demand for microprocessor functionality, what microprocessors were asked to do, rose alongside of semiconductor advances. PCs required microprocessors able to perform more complex operations more rapidly, in small packages, and using less energy in order to keep up with user demands. As a result, the scale of required microprocessor R&D tended to increase over time relative to the size of the microprocessor market. This meant that the space available for viable competitors was decreasing rather than increasing, unlike the situation for memory chips. Second, effective memory chips could be designed without reference to particular software programs and operating system. Microprocessor efficiency depends, importantly, on the sequences in which, and the frequency with which, particular operations are performed. Component and subsystem placements within a microprocessor must be optimized to facilitate the most frequent operations and sequences of operations. These in turn depend on the software environment in which a microprocessor operates. Thus, Intel's experience interacting with Microsoft programs, which constituted the dominant PC software environment, gave Intel important advantages in microprocessor design that it had not enjoyed in memory chips. Third, to nurture these potential competitive advantages to establish dominant scale-protected positions in the PC and server microprocessor markets would require a management focused almost exclusively on these products and able to cooperate effectively with the major software providers. Given the often messianic ambitions of tech managements, Intel's ability to maintain the necessary narrow focus and cooperative attitude was by no means certain, although by the mid-1980s, Intel did have a good track record in this regard. Again, as with the memory chip companies, successful investors in microprocessor companies such as Intel would have needed a detailed understanding of both the industry economics and the capabilities of managements. Finally, as it gradually became apparent in the late 1980s and early 1990s that Intel would achieve a dominant market position in PC and later server microprocessors, its stock price inevitably rose. A successful investor in Intel stock would have had to be able to determine whether, at such prices and in the face of divergent future possibilities, Intel was an attractive investment. This is a much more complicated undertaking than analyzing WD-40. At each stage in Intel's history, alternative future trajectories based on different industry evolutions and management behaviors would have to be considered. At any given time, Intel might be a Case A investment, asset value above EPV due to poor management and a varnished franchise, as was the case of several other memory chip competitors. Case B, capable management in a competitive industry, or Case C, growing franchise company. In evaluating Intel, we must apply all three valuation techniques: asset value, earnings power value, and estimated returns that we have developed. Only a liquidation analysis seems unnecessary. Valuation 1. Reproducing Intel's assets. Once Intel's competitive advantages in memory chip production had evaporated, its value would have been rooted in the value of its assets. Without barriers to entry, earnings levels above those necessary to provide an adequate return on these assets would be rapidly eliminated by the entry of efficient competitors. Since these competitors would themselves need to earn an adequate return on their own investments in memory chip production, they would not enter the market if industry earnings were insufficient to provide this return. Thus, if the investments required by efficient entrants were comparable to those of Intel, meaning that Intel itself was an efficient operator, then the value of earnings would have to cover the cost of reproducing Intel's own assets. The value of Intel's future earnings would therefore be largely determined by that cost, which is the natural starting point for valuing Intel. One simple way of estimating that reproduction value is to take Intel's accountants at their word and use Intel's accounting book value. A decision on whether to purchase Intel stock could then be made by comparing the book value of Intel's equity to its market value, whether for the company as a whole or on a book value per share compared to price per share basis. The shortcoming of this approach is that without careful analysis and adjustment, book values may be a very poor measure of the reproduction value of a company's assets. Still, as we noted earlier, buying stocks at substantial discounts to book value has been a successful investment strategy. It is also easy to do. It is therefore an appropriate strategy for investors who don't want to do a lot of work. Unfortunately, few successful businesses are available for sale at book value, and even fewer at a discount sufficient to provide an adequate margin of safety. Just to be certain, Table Example 4.3 presents the book value and market value figures for Intel over 5-year intervals starting in 1975. A graph of the market-to-book ratio over the entire period makes the relationship more apparent. For the years between 1980 and 1995, Intel traded at between 2 and 4 times the book value of its equity. These are all end-of-year numbers. During each year, Intel stock price hit highs and lows that differed, sometimes significantly, from the price at the year-end, but only in the general market run-up in the first half of 1987 did the company's market value exceed more than 4 times the value of its equity. This relationship lasted until the end of 1995, when the investors decided that they could pay more than 4 times the book value for a company as successful as Intel and still make money. The market-to-book analysis is quick and sometimes a bit muddy, if not downright dirty. To get a more precise take on what a competitor would need to spend in order to get into the business, we have to look at the assets line by line and calculate, sometimes estimate, what their replacement costs would be. We went through this exercise in chapters 4 and 6, and the guidelines for adjustment remain the same. Table example 4.4 presents Intel's assets as listed in its financial statements for 1975. We have made virtually no adjustments to the assets as reported on the balance sheet. Intel did not use last in, first out, LIFO accounting to value its inventory, and it had not purchased another company in a transaction that would have landed goodwill on its books. That leaves property, plant, and equipment, PPE, as the account that needs scrutiny. Intel owned chip factories, fabs in industry parlance, in the Santa Clara region, and it had stocked them with the sophisticated equipment and clean rooms essential to turn out integrated circuits. It was a young company in 1975, so none of the plants or equipment would have been very old, although it had bought its first building used from Union Carbide. On the other hand, the industry was changing rapidly, and the rate of obsolescence in semiconductor capital equipment may have been faster than the depreciation Intel was charging itself. A competitor might have been able to duplicate its facilities for less than the book value of its assets. We can test how realistic is the stated value of PPE by comparing it with the actual capital expenditures Intel made. For almost every year in the entire public history of the firm, Intel's net PPE had been more than the sum of its last 4 years of capital outlays and less than the sum of the last 5 years. Only if one thinks that a competitor could replicate Intel's entire production and research facilities with substantially less than 4 years' worth of its expenditures is the net PPE figure overstated. Conversely, if Intel's net PPE number understated the real market value of its fixed assets, it would not have needed to spend the equivalent sum every 5 years. The net PPE figure stands up as a reasonable figure when measured against capital outlays. If there are other assets that a competitor would have needed to produce to compete with Intel, they are not found on the balance sheet for 1975. That does not mean they didn't exist. Intel, we should not forget, was a new economy stock long before the new economy had a name, at least in its post-1920s incarnation. As an early and major manufacturer of memory chips and then microprocessors, Intel invested in knowledge-based resources, the science and engineering skills needed to design and fabricate semiconductors, and supplied knowledge-enhancing products, which were the memory and brains of computers and industrial equipment to its customers. But Intel's investments don't appear on the balance sheet because, under accounting rules, R&D is generally treated as an annual expense rather than a capital expenditure. Unlike utility bills, computer paper, or real estate taxes, money spent wisely on R&D should continue to earn profits for the company long after the checks have been cut. The expertise essential to design and produce these chips, everything from Andrew Groves' 1967 book, The Physics and Technology of Semiconductor Devices, to the months of trial and error involved in increasing the yield on some stubborn manufacturing process, does not come cheaply. Once purchased, it has lasting value. And not all of that knowledge is reflected in the R&D expense account. Some of it no doubt disappears into the cost of goods sold as a manufacturing expense. The investment in knowledge that shows up in Intel's income statement has been considerable. We wrote earlier that R&D averaged 11% of sales for the period 1975 to 1998. Any company trying to compete with Intel would need to spend considerably to build up an equivalent expertise. How much would be enough? Some analysts have suggested treating R&D as a capital investment and depreciating it on a straight-line basis over 5 years. If we simplify and say that this past year's outlays should be fully valued as an asset, last year's at 80%, and so on, we can calculate the value of an off-balance sheet intangible asset that estimates what a competitor would need to spend just to get into the business. For Intel in 1975, that amount would have been $27 million. This would have increased the reproduction costs of the assets by 40%, and the book value of equity from $74 million to $101 million, a gain of 37%. There are other ways to gauge the costs of reproducing the knowledge base. If we use the sum of the last 3 years spent on R&D, the figure would be somewhat higher than our depreciated total. Using the sum of the last 2 years would give us a slightly lower number. All of them might be understating the reproduction cost. Perhaps a competitor would need to spend 5 years' worth of R&D to become viable, or hire away some key Intel employees at a premium and then pay the court costs when Intel sued. We will use the 5-year depreciated figure as a conservative estimate of the reproduction costs of Intel's storehouse of knowledge. There is another non-tangible, off-the-balance sheet asset a competitor would have to create in order to compete with Intel. Almost every company needs to spend money marketing its wares. In Intel's case, though, it took several decades before they started to spend serious money telling consumers about the advantages of having Intel inside their computers. From the start, they sold highly technical products to a large number of sophisticated purchasers. This sales effort involved more than posting a list of specifications and prices for the semiconductors they offered. Sales executives had to work with customers to understand their needs and to win contracts. Any new competitor would have had to develop the rapport with customers and their specific requirements to go head-to-head against Intel. All this effort costs money. It takes time to build the relationships with the engineers and the customer firms. It is not possible to produce a hard figure for the magnitude of Intel's spending on marketing, which would include primarily the salaries and commissions of the sales staff and money spent on advertising and other forms of promotions. The amount for advertising is broken out, but until 1990, it never amounts to even 8% of the marketing, general, and administrative MGA expenses. To arrive at a reasonable number for what a competitor would have to spend to draw even with Intel requires making some estimates. 1. To even out the annual variations, we take the average of MGA as a percent of sales for the most recent 5 years and apply that to the current sales figure. 2. We assume that it would take 3 years of marketing expenses to get up to speed with Intel. 3. We set the share of MGA spent on running the business at half the total, leaving the other half for marketing. Each of these assumptions can be challenged and refined. Our aim is to arrive at a reasonable number to add to Intel's assets as an indication of the reproduction costs a new entrant would face. The amount is significant, slightly larger in most years than the R&D adjustment. When we include an adjustment for both R&D and marketing, we lower the market-to-book ratio for Intel by a considerable amount. There were several years in the period after 1975 when Intel could have been purchased at adjusted book value or slightly less. Again, we are looking at year-end equity values and year-end prices. In some years, the interim prices were below the previous year-end. Starting at 1982, Intel began to invest in other companies, generally with the aim of advancing Intel's overall strategy, which was to encourage broad demand for microprocessors. Intel marked to the market the stock of publicly traded companies in this strategic portfolio. For privately owned companies, it valued the shares at its cost. We see no reason to challenge the company's practices here. Only if the privately owned shares had declined substantially since Intel's investments would it be necessary to adjust shareholder equity downward. We have made no modifications to the liabilities on Intel's books. Over the years, the company did build up a sizable deferred taxes account. If that figure were discounted to the present, the liabilities would decline and the equity would therefore rise. But the adjustment is minor and only becomes visible in the years after 1995, when the market value of Intel greatly outstripped the book value. Measured against book or adjusted book value, the three best times in the history of this period to have purchased Intel shares would have been 1. In January 1982, when the market value of the whole company fell briefly to around $925 million, compared with an adjusted book at year-end 1981 of just over $1 billion. 2. In August 1986, when the market value was about $2 billion versus an adjusted book value of $2.5 billion. 3. At the end of 1988, when the adjusted book value of $3.9 billion was about even with the market value. Had an investor been disciplined or fortunate enough to load up on Intel every time its market value came within hailing distance of its adjusted book, the results would have been excellent. At no time subsequent to the purchase would the value of the shares been lower by any meaningful amount, and the gain over the next 5 years would have been substantial. Now, all of these dates occur within the extended bull market that began in August 1982 and persisted into the year 2000. The investor in Intel would have been sailing with the wind. Still, purchasing shares at the start of 1982 and holding them into the one very rough period in Intel's history would have provided a decent return, though slightly below the returns on the S&P 500 index. Nevertheless, it is important not to be lulled by the comfort of hindsight into thinking that these decisions were easy to make. In early 1982, the coming of competition to the memory chips began to seem inescapable, and the progress toward dominance of Intel's microprocessor position was hardly certain. The IBM PC had only entered the personal computer market in late 1981, and there was always a very real possibility that IBM might produce its own microprocessors. If Intel could not acquire sustainable competitive advantages either in memory chips or in microprocessors, then as a competitive player, asset reproduction value would capture the full value of future earnings that Intel could expect to enjoy. In 1986, Intel was incurring large losses, and in late 1988, Intel's earnings began to decline once again. Having the confidence to invest in Intel under these circumstances would have required, as we pointed out before, a highly developed understanding of Intel's market position and management. On the other hand, the fact that Intel was trading at or below net asset reproduction value in a viable industry provided significant downside protection. Assuming that Intel's management was capable of making efficient use of these assets, taking a flyer on Intel's future would not have entailed serious losses, even if that future did not pan out. The key here would be Intel management's ability to make efficient use of its assets, which would be reflected in the long-run earnings power that Intel was able to generate. Thus, the next important step is to look at Intel's earnings power value. Valuation 2. Earnings power value. Here we will follow the approach we took in valuing WD-40 based on earnings power. The underlying assumptions are that the company will not grow, that its current earnings are sustainable for a long period of time, and that a shareholder, as an owner of the company, will receive as his or her return a proportionate share of the company's distributable earnings. The no-growth assumption works easily with WD-40 but it certainly does not fit Intel, a dynamic company in a rapidly changing and expanding industry. Therefore, it requires a considerable dose of strategic analysis to produce a reasonable estimate of Intel's constant earnings power in any particular year. Since the question we want to answer is whether and when Intel shares presented an opportunity to investors adhering to the valuation criteria we have established, we can look only at information that would have been available at the time. As we have heard, an estimate of the company's current intrinsic value on the basis of its earnings power requires two steps. First, adjustments to the reported earnings to arrive at a figure that represents the cash the investors can extract from the firm and still leave it functioning as before. Second, selection of a discount rate that reflects both interest rates and the riskiness of the firm relative to other investment alternatives. Dividing the discount rate into the adjusted earnings gives us our earnings power value, EPV. Adjusted earnings, special charges, business cycles, R&D, and D&A. We will concentrate on the years from 1987 on, after Intel abandoned the memory chip business, and just as the personal computer revolution began to hit its stride. As with WD-40, we begin with operating earnings and make our adjustments from there. The first adjustment concerns special charges. These are the write-offs companies make when they revalue assets, such as inventory, equipment, or other investments they have made, or make provisions for layoffs, plant closings, and the like. The justification for keeping these charges separate from operating earnings is that they are singular events that do not affect the company's permanent earnings capacity. But in fact, each of them represents the accumulation of real expenses the company has incurred in the course of its business. If these charges persist from year to year, it means that the company is understating its true operating costs. To smooth out the erratic nature of these special charges, we take an average of the charges for the current and 4 prior years and deduct that from operating income. Second, unlike WD-40, Intel's sales and earnings were not immune from cyclical swings. When Intel was involved in the memory chip business in the 1970s, its operating earnings margins were as high as 30% and as low as 20%. But in the microprocessor business, where there was less competition and the market was growing, it seems unlikely that the margins vary as much. In the years 1987 through 1991, as sales grew rapidly, operating margins stabilized at somewhat more than 20% and even increased during the recession of 1990. So we think it is conservative to use 20% reported EBIT as a base for this period. Third, for Intel, R&D was a major expense each year, averaging more than 12% of sales from 1987 through 1991 and hardly falling off after that. These were growth years for Intel, and we have to assume that some of that R&D was spent to support that growth. But in the fast-changing world of integrated circuits, a company will need a large R&D budget just to run in place. So to get a more accurate picture of the earnings power with zero growth, we ought to add some of the R&D expense back to operating earnings. But how much? We can take the approach we used in calculating the replacement cost of the assets, which was to treat R&D as a capital investment and depreciate that over 5 years. Each year's expense would be the depreciation charge, which is somewhat less than the actual R&D cost. A second method is to estimate a maintenance R&D on the same basis we estimated maintenance CapEx, by capitalizing R&D into an asset, finding a sales to asset ratio, and using that ratio times the dollars of additional sales to arrive at the growth portion of R&D. Maintenance R&D is simply the other portion. A third way is to look at the R&D spent by the closest competitor, in this case, Advanced Micro Devices, and use that number as the necessary Intel expense. Finally, we can take a guess and say that at least a certain percent, we will use 25% of Intel's R&D, can be attributed to growth and therefore should be added back to EBIT. Having done all of these calculations, we are going to use the last one here. It is the most conservative in that it produces a smaller increase in current earnings than any of the alternative methods, and it is the simplest to implement. Fourth, the adjustment for R&D can also be applied to selling, general, and administration, SG&A, a substantial part of which is spent on winning new business. We will add back 25% of the total, a rough estimate, but again, a justifiable and conservative one. Fifth, we can't escape taxes. For all these years, we will assume a tax rate of 38%. This is higher than the accounting tax rate reported in Intel's audited financial statements, and it gives Intel no credit for whatever clever management of its tax liabilities it achieved. It is a valid and conservative estimate of taxes on operating income. Sixth, we need to adjust for depreciation, amortization, and maintenance capital expenditures. Here some knowledge of the industry helps. The cost of semiconductor capital equipment, the big and expensive machines that Intel used to make its microprocessors, had declined over the years when improved capacity is taken into account. As a result, Intel's depreciation expense, which is based on the historic cost of its machinery, overstates the amount Intel would have to pay to keep its production capacity level. Rather than adding back all of depreciation and amortization, D&A, to EBIT after tax, and then subtracting the maintenance portion of capital expenditure, we will simplify the calculations and add back 25% of D&A, assuming that the other 75% will be more than enough to cover maintenance CapEx. There is nothing magic about the 25% figure in all these calculations. We use it because it seems both reasonable and conservative. Making all these adjustments gives us the following adjusted and distributable operating earnings for Intel in the years 1987 to 1991, as shown in Table Example 4.7. After all that hard work, the differences between reported net income and adjusted and taxed operating income is not enormous, but that is only a rough check on the legitimacy of the estimations.